You're going to want to check this out. Banking secrets you should know. Throughout history, banks have served as the financial capital of every society. Did you know that the Federal Reserve is a bank? It is also known to be the only bank that issues new currency. But I suppose I told you that every bank, wherever in the world, may issue its own currency? You could, in theory, open your own bank and begin printing money right away. But there's a simpler option. Lately, the cryptocurrency trend is paving its way in making people a crypto billionaire in just a blink of an eye. If this sounds like a scam to you, you might want to learn more about how the banking system works. In this video, we will talk about the things you need to know about banks that will certainly change how you use them. If we all know about these things, the banking business will surely go bankrupt. There might be a revolution if we are all aware of the things that make these banking businesses successful. Before we get started, don't forget to subscribe to our channel and turn on notifications to learn more about wealth and get updates on our content. Alright, let's start with number 5. Debt can be better than savings. Borrowing money from banks and putting it to good use in other investments is a viable strategy for profit. In 2012, Mark Zuckerberg, 28 years old, was ranked as the 40th richest person in the world with a net worth of $15.6 billion. He took up a 30-year mortgage on his $5.95 million Palo Alto mansion in July 2012, which is located only 3 miles from Facebook's headquarters. The issue here is, why did he go into debt when he has billions of cash and can simply pay it off? He could spend millions of dollars on a dozen houses without blinking an eye. Therefore, why should one consider mortgage? The mortgage is actually free money. You might be puzzled right now because no one in their right mind would give out money for free except for charity. It's all related to interest rates. The return on investment offered by banks is so small that it's basically a loss due to the fact that it fails to keep up with inflation. Actually, it's the opposite way around this case. With an annual inflation rate in the United States between 2.5 and 3%, any funds borrowed at a rate lower than this amount are effectively interest-free. The interest rate on Zuckerberg's mortgage was just over 1%. In this scenario, the bank comes out on the losing end of the deal since the mortgage rate is less than the rate of inflation. To better understand the idea, suppose you borrow $1 million at 1% interest. Before the pandemic, the average rate of return on a savings account was 2.4%. Now, it's less than 1%. But for simplicity's sake, let's choose 2.4%. That $1 million will still generate $24,000 annually after being deposited elsewhere, and you'll just have to pay back the bank that lent it to you at the rate of $10,500 each month. Think about using this trick with a large amount of money, 100 million or even billions. There's no need to invest your own money when you can borrow for free and put that cash to better use elsewhere. If you are thinking about investing a small amount of money using this trick, you may not notice the difference. But when dealing with large sums, a 1%, 2%, or even a 0.50% margin of error might cost tens of thousands, if not hundreds. Before we continue, if you want to make some quick cash, then you can click on the link in the description of this video. You can make some money fast with no experience required. Alright, let's get back to number 4. Banks love credit cards. Credit cards are like nukes for banks. Credit card debt is different from mortgage debt. It's not even close to 3.5% annually. It's probably over 20%. If you believe that you will be able to pay it off in the next few months, when in reality, you can't even pay it on time, you'll be doomed because your debt will be much larger. Statistics show that 70% of Americans who have credit card debt will not be able to pay it off this year, which means that 70% of Americans are on the verge of falling into debt trap. 66% of respondents admit to having credit card debt for more than a year. Nearly 20% think that it will take them more than 3 years to pay off their debt, while 8% don't have a clue when they'll be capable to do so. And because most consumers do not give much thought to how they will repay their debts, this is a common way for banks to amass large profits. They have become used to a certain lifestyle and are determined to maintain it regardless of their financial situation. That's why the bank keeps on contacting you to try to offer a new credit card. But don't be intimidated by credit cards. If you use it responsibly, you will be able to establish and maintain a positive credit score. So, be wary of spending too much so you won't get yourself in debt with the bank. Number 3. Printing money. Every bank is free to print its own currency. We are all aware that the Fed is the only bank authorized to produce money. It is the sole entity with legal access to operate the currency printing press, serving as the currency's creator. So, you might be surprised to know that every bank is allowed to produce its own money. However, the way the banking system is set up, any bank in the world may issue its own currency up to a specific limit determined by the amount of money deposited there. To further understand it, imagine that you are going to deposit your $100 in a bank. What do you suppose the bank will do with the cash? The bank actually loans your money to someone who wants to purchase a car or a house, and in return, gets interest that is typically larger than that of the interest they offered you, which is only 0.5%. Another is credit cards, which have an average interest of 20%. That is a very high rate of return, several times more than what the bank offers you. What we are trying to point out is that the bank will not specify borrowers for loan applications. And by opening your online bank application, you will see that your money is still in the bank and you can withdraw it anytime you want. But where did the bank get the money to lend it to someone else? This is what we call fractional reserve banking. If you deposit $100, the bank will generate $90 out of thin air in order to make loans to other customers, summing it to $190. Banks are only permitted to retain 10% of customer deposits and lend out the remaining amount. It may look complicated due to the numbers on the screen, but if you grasp the idea, it is actually easier to understand. Number 2. The rich gets the best rates. If you're wealthy, you'll receive a lower rate than someone who isn't. You might want to become rich to get this benefit. The reason why banks prefer lending money to a wealthy person rather than a poor person is that, as with any other kind of company, a bank's primary objective is to generate a profit for its shareholders. Ultimately, they must answer to their stockholders. They won't be able to stay in business if their model isn't sustainable. It's far less risky for a bank to lend you money if you're a billionaire, since no one will be anxious that you won't be able to make your monthly payments. If anything does happen to you and you can't make your payments, you can always sell some of your business to pay off your debt. Indeed, that is how the banking system developed throughout the ages. Banks would only negotiate with the elite, with individuals who had either a large amount of money or assets that generate revenue on a regular basis like land. Typical workers face the risk of being ill, being injured on the job, or simply being let go more often by employers. It is a huge risk to lend money to someone who is already struggling to make ends meet. Knowing the fact that banks have this behavior, it is easy to condemn it. But if you give it some thought, is it more likely that you'd lend money to a friend who owns a business rather than a friend who earns minimum wage, right? It may sound harsh, but it's the reality. You'll need to improve your financial situation for you to access better conditions for borrowing money, such as a reduced mortgage rate or credit card interest rate. Banks want to build trust with their wealthy customers so that they would return to them if they need a larger loan, perhaps for a business expansion, and both will benefit from it. Compared to previous years, financial services are now available to everyone thanks to the democratization of banking. The introduction of blockchain and cryptocurrencies like Bitcoin promises to change how banking works and make it more accessible to more people. Number 1. It is a scam. Putting your money in a bank is actually a scam. Looking at the interest rates offered by the banks when depositing your money, surely there must be some percentage for it to make any sense. But if you check the figures, you'll see that it's not even close to being true. The top banks provide interest rates of less than 0.5%, but there may be some banks that offer higher rates. However, it wouldn't be higher than 1%. Considering the situation that we are facing right now where the inflation rate is 2.5%, the 0.5% offered by the banks doesn't make any sense. Spending money now for the things that you want is significantly better than putting it in the bank. In a few years, your money will be worth a lot less than it is right now due to inflation. As we have witnessed over the last year or two, asset values such as real estate and equities soar while inflation is surging. If you think that keeping your money in a bank will help you earn an income, you need to rethink it. That's it for this video. If you enjoyed this content, please press the thumbs up button. You can also leave comments to let us know your suggestions and thoughts. See you next time.